Discussions in this show are for entertainment and educational purposes only and should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Securities offered through registered representatives of Cambridge Investment Research, Inc., a broker-dealer and member of FINRA and SIPC. Advisory services through Cambridge Investment Research Advisors, Inc., a registered investment advisor. Cambridge and neither SmartPro Financial nor Bridgeway Wealth are affiliated. Hey guys, welcome back to the Working Wealth Podcast. I'm Patrick.
And I'm Trevor.
And we are here to talk about money. Fun. Awesome. If you haven't checked out our last few episodes, please do us a favor. Go back and find something you like. Give us a good like and a share, and send it to somebody who you care about. Or if you want to be like a little bit passive aggressive and judgmental, find something that you think somebody should hear and send it over to them.
That is always an option.
Is that a bad way to start for today? Or are we good to go with that? Because I'm good to roll
I'm good.
with it.
I'm good to roll with it.
Okay, I'm feeling spicy
I like
today,
it.
guys. So, awesome. On a serious note, we're so grateful for your paying attention and giving us some of your time and some of your focus, because we know that everybody's arguing and fighting for focus these days. But we want to talk about something really, really important because, I feel like we kind of go through these themes in client meetings where there's just kind of the same question or same underlying theme that comes up on a regular basis. And today we're going to talk about, just kind of high level, is what are the different tax buckets and where do they fit, where do they not fit?
Yep.
And maybe some of that's coming out of, people thinking about retirement. Sometimes it's coming out of we're recording late April 2026, right? So we have some relevancy with tax time and people seeing their tax refunds or tax bills, things like that. And it's really important to think, especially with where we are today in the economy. Well, how do I access my money?
Yeah.
And what are the implications of how I access my money based on where it is? And then thinking going forward, how should I be putting my money in different buckets to give me more flexibility or options down the road?
Yeah, absolutely. And every different tax bucket has its place. And you can make arguments for or against all of these in different scenarios. And that's why, really we always go back to the tried and true formula of it's dependent on your personal financial situation.
Yeah.
But there are some really good general, kind of overview items that we can talk about today, Patrick, about these different tax buckets, when they might be practical, when they might not be practical, and kind of how they can, fit into your situation.
Yeah. Awesome. So where do you think we should start, Trevor?
Well,
I'll let you lead this one.
I would say Pretax. That's kind of
Okay.
I feel like Pretax and Roth, those are the really well-known ones.
Yeah.
And we can kind of leave the third tax bucket that a lot of people are not aware of for the last, if you're good with that.
Yeah, let's do it.
Perfect.
Love
So Pretax, I think the first thing that we should do is kind of break down what that actually means. So Pretax, when you're making a Pretax investment, it is being deducted from your actual income on the front end and being invested for later. So there are a lot of pros and cons to that. We'll break those down, but really the high level definition of what a Pretax investment is we're putting money away that has been taken out of our paycheck before taxes have actually hit our paycheck. We're getting it deducted from our income so that it drops our actual taxable income in the moment on the front side of things. And then we're taking those dollars that we've pulled away from our income and put them away for the future.
Yeah, and I'll add a little bit more color to that too. So that's talking about if we have a pre-tax account with an employer.
Yeah.
So a pre-tax 401k, 403b, 457, could also be HSAs, things like that. Maybe on a more broad scale, still talking about that type of taxed money is we say pre-tax because it's effectively you're getting a tax deduction if you qualify based on certain criteria.
Yep.
And that's kind of what I want to just touch on briefly is so there's really two different top line realms of accounts. You have qualified money and non-qualified money. Qualified, all that really means is, hey, I follow certain rules and I get to qualify for certain benefits.
Yep.
Those benefits are always related to tax advantages, right? It's the pre-tax money we're talking about to start off with is going to be I put money in a certain way and I qualify based on income levels or other certain factors to where I can get that tax deduction for that contribution today.
Yep.
This is predominantly related to what we also like colloquially, that's a big word.
Yeah.
That's a $10 word, way too expensive today. So like talking about like traditional money, right? So like if people talk about like a traditional IRA or traditional 401k, like that is the same thing as that pre-tax. You could also say like, if we go to the technical terminology, like the IRC, Internal Revenue Code, those publications, it's tax deferred, right?
Yeah.
But yeah, like I think pre-tax is what most people probably hear that as. But just to give some correlation of like, people throw terms around all the time, not knowing what it is. So I think if you understand pre-tax, traditional, like tax deferred, those all really mean the same thing. We're talking about the same kind of bucket, right? Like
they do.
It's a red car, right? That's what we're talking about here.
And this has been kind of the predominant way to invest, especially when it comes to employer investments over time. Since really these kind of tax buckets came around, that's been the predominant way, and it's the kind of the oldest way. That we look back and we see how the tax code has been structured over the years for long-term investing, pre-tax, tax deferred. That has kind of been the gold standard, or the way that people have largely invested over the years.
Yeah, and I think we've talked about this before, but it might have been like 2.5 years ago, honestly, on an episode. But like that's why it's called traditional, right? It's like it was the way it was traditionally done when the laws were passed in the early to mid 70s of the 1900s. By the way,
yes.
So we're talking about like almost 60 years ago. But yes, like that's the traditional way it was done, back then. Yeah.
And a lot of our clients that come in, that are, in their 50s and their 60s and their 70s, this was the predominant way that they invested over the years. And so, with the pre-tax bucket, I think there are a lot of considerations to make and a lot of just things to know. So, there's always, when it comes to the IRS and the government giving us benefits, there are always kind of some caveats and some things to consider with those benefits, right? There's going to be usually a positive and a negative, or a benefit now and something to pay later.
Yeah.
So Patrick,
Trade-offs.
Trade-offs. That's probably a better way to say that. Do you kind of want to break down high level what the trade-offs are with pre-tax money?
Oh yeah. Do I have to be nice to the government with this?
You can be as
okay.
mean or as not.
Yeah. So I mean, I could be so cheeky about this topic, right? But yeah. So like with the pre-tax assets, the point, like you mentioned, is like I'm putting in income today. I can qualify for the tax deduction, right? I mentioned before there's this term like tax deferred. So what that relates to is like I put the money in and I get the deduction today. So essentially that money is not taxed, like what I put in. But if I keep it inside those buckets and I follow certain rules, like for retirement accounts, don't access it until I'm 59 and a half years old. Take it out for certain like exclusionary measures, things like that. I get the benefit of tax deferred growth. Now, what that actually means is I'm just deferring when I'm going to pay taxes on it. But all of the growth in that account, I don't have to pay tax on that today because it stays inside that account and I'm using like a certain qualification measure, like being in a type of an account. I don't access it except for certain reasons, things like that. So the key with that is I get the deduction today, but down the road when I take that money out, and to clarify, like we never or like almost never recommend like you get to retirement, take it all out at once, right? I think that's kind of a common misconception is like you don't just take money out of your 401k, put it in the bank. Like we leave it inside tax qualified accounts. Like, but as I take dollars out, I'm going to pay the tax on it. And the good illustration we like to use for this is I can choose to pay tax on the seed, or I can choose to pay tax on the harvest, right? And so like the pre-tax, traditional, tax deferred, whichever one you want to use to name it, I'm choosing to pay tax on the harvest. And they're like, depending on who you talk to, planning wise, some people might say, well, you should just always do this. And there are some like, generic things people talk about of like, well, if I'm in a higher tax bracket today, I should do pre-tax because I'll be in a lower tax bracket in the future. I always say it depends. Like,
and we don't know.
And we don't know, right? It's like it depends. Like, let's pretend like tax brackets stay the same forever, which it's all written in pencil.
Yep.
Even like the tax bill passed last year, they said there's permanent things. Well, some of those permanent things were changes from the prior legislation, which were permanent
Yep.
in 2022, which were also permanent in 2020, which were also permanent in 2017.
Yep.
Like the tax code's written in pencil. It all depends on who's elected.
Very true.
I'm getting off track. So, but yeah, so like if tax rates stay the same forever, it still depends.
Yeah.
Because what we have to think about with the way our tax system works is it's all income stacking.
Yeah.
Right? Like the amount of tax I pay or the bracket that I fall into depends on all of my income sources together.
Yep.
My general thought and what I've seen a lot of practice over the past 9 years being in this business is if I'm a really good investor and I'm like a really good at like high savings rate planning for the future, more than likely you're going to be in the same or higher tax bracket down the road if you do your pre-tax savings.
Yeah, absolutely.
So it really depends, and you got to look at your personal situation. But the colloquial thought is, or the common thought is, you know, I'll be in a lower tax bracket in retirement, so I should do pre-tax now.
Yep.
But the catch with that, right, is like maybe,
Yeah.
right, and maybe in terms of the tax brackets, because what a tax-deferred savings vehicle actually is an unsecured IOU to the IRS. And everybody talks about like Uncle Sam, right? You know, and he's kind of a greedy guy and like, you know, kind of thing. What they forget about is his wife, which is Aunt Iris. Aunt Iris is the force behind Uncle Sam, right? That is, and I'm being joking when I say this, right? But like, it's the IRS. And that's the enforcer, right? So if you have pre-tax assets, you are really taking a bet on what the future is going to hold, right? And I know like the naysayers are going to say like even everything we talk about with Roth as being like the converse of this. They could say the same thing like, well, it's written in pencil, it can change. The precedent is that when big breaks are given, they don't get taken away. They get evolved or built upon. They don't get reduced.
Absolutely.
But yes, like it's kind of like an unsecured IOU. So if I have $100 today and it grows to $10,000 down the road, if I do it as tax deferred, pre-tax, traditional, whatever you want to call it, well, maybe I'm in a 12% tax bracket now. Maybe that stays the same down the road, or maybe the government decides, well, we're going to do away with the 12%. Now everything is back to 15 like it was, you know, pre-2017. So you're kind of taking a bet. Like it's kind of like a payday lender in a way. It's like, well, I don't really know what my interest rate is.
And I also think like when people make that statement of, oh, well, my tax rates are going to be lower in the future than they are today, they're not actually looking at all the different assumptions. And Patrick, you kind of hit on this. It's not just about, oh, am I going to be making the same or less money? It's also about there are other things to consider, like Social Security payments, like pension payments, like other factors that can contribute to your actual taxable income in retirement or later in life when you're actually going to use these pre-tax assets. And they can make a big difference and a big impact on where you actually fall in the tax brackets.
Yeah, and I would say more common than not is people are in the exact same tax bracket as they were in retirement because, like, especially for people recently retired and retiring in the next, like, 5 years, we see that most people, and most of our client base, they're either in, like, the top of the 12% marginal bracket up to, like, the bottom to mid of the 24% bracket. So you're, like, just under $100,000 of taxable to just over, or like right around $300,000 of taxable income. Like, and that's not gross. That's like gross after deductions gets you taxable. Most people stay in the same bracket, just practically speaking, because like I might trade $120,000 of salary income for $80,000 of Social Security, and then I have maybe some investment distributions, pension on top of that. It's a 1-to-1, right? And again, that's like we're not starting this like with a negative bent towards pre-tax. It's just thinking through it proactively. We just see, practically speaking, most people fall in that same vein.
And not only do they stay in the same vein, but when you think about the actual just dollars and cents, you're putting in a lot more, or you're putting in a lot less on the front end. So you're getting a much smaller proportional break on the taxes. Later, when that money is a lot bigger, that big stack of money has grown, you're not only in the same tax bracket that you were before, but you're paying on a much bigger chunk of money.
Yeah.
So
and like it's proportional as you take it out, but still, like if I
actual
put in
dollars
10, I'm
paid
taking out
to-
100.
Yep.
Like
the dollars
Yeah.
paid to the IRS, to the government, are much greater
yeah.
if we're using pre-tax dollars in most cases.
Yeah,
In all cases.
and I so badly want to talk about like inheritance and like how that
Yeah.
plays in right now,
Yeah.
but I think maybe talking about Roth first,
Yeah, absolutely.
would be helpful.
Yeah. Okay.
So, but yeah, it's like high level, like pre-tax, traditional, tax deferred. I put money in, I can qualify for deduction today. Yep. It's an IOU to the government that I've got to pay whatever they say the rates are down the road at that point in time. Tax on the harvest, not on the seed.
Absolutely.
So those accounts really came about in the early 70s, part of the Employee Retirement Income Security Act that was passed, which was really kind of the result of, I would say, a lot of lobbying and legislative shifts to take the burden of retirement care off of corporations and put it into the hands of the employees, which is why it's the Employee Retirement Income Security Act, creating the opportunity for people to invest in tax-deferred or tax-advantaged ways to save for their own future instead of having companies have to maintain and manage pensions, right?
Yep.
Really, I would even say like the democratization or like the earliest like mass access point to the markets for most people.
Yeah,
Like
absolutely.
before that, you didn't have as many people with access or as rampant access to the broad scale like global markets.
Yeah.
So that's that. We have the other type of qualified money.
Yep.
There's really a few other types of qualified money, but for retirement specifically, right? You have pre-tax, then you have Roth.
Yep.
And Roth, I forget the guy's first name, but it's named for the senator.
John.
Sure, we'll say John. It might actually be John.
Yeah.
But so it was Roth is actually the last name of the senator that pushed the legislation for creating a new type of tax qualified account, which is just the flip of pre-tax, right? So Roth is, instead of me getting taxed on the harvest down the road, I'm paying tax on the seed, and then the harvest is 100% tax free. So like I might pay 10% of my seed up front, but now I get 100% of my seed down the road versus I pay 0% on the seed and I pay maybe 10 or higher on the harvest in the future.
Yeah, absolutely.
I love Roth. Oh man,
we both do, and
so much
we
for 100 reasons.
Yes,
like we don't have enough time to talk about how great Roth money is, but I'll say this, right? So there are requirements and stipulations, just like with the pre-tax. You have to qualify for the tax deduction. If you're using an employer plan like a 401k, 403b, 457, like those qualifications are just baked in because they fall under certain guidelines with Department of Labor and other rules. The IRAs are different. That's where you have income phase outs for qualifications. But like the Roth money, same kind of thing. Employer-sponsored plan, basically no restrictions or no like phase outs. For the IRAs, you do have like certain income-based phase outs. The key thing with all of that, though, is it's qualified money. You follow the rules, you get the benefit, right? It's qualified because it's special provisions in the tax code for both of these types of money and how it grows. If you break the rules, you don't get the benefit, right? So that's why there's like the 10% early withdrawal penalty. You know, if you take money out of these accounts, like you might have an additional tax penalty because you're breaking the rules of getting the tax benefit over time. And there's also a lot of thoughts around like, well, why is it 59.5? And why is like, I started looking that stuff up recently. A lot of it's just based on like longevity and lifespans when the laws were passed.
Doesn't surprise me.
Right. But so Roth high level was passed in the 90s of the 1900s, by the way. So it was passed like late 90s. I think it was 97 when the law was passed. So it's still kind of new, right? Like we're talking next year will be 30 years. So we don't see as much large Roth balances for the masses for people that are coming up to retirement, which is a problem from a planning perspective, but there's also a lot of grace there because it's new, right?
Absolutely.
And even until the past 2 years, 401k plans were not required to allow Roth assets. Like that's a new thing under recent legislation changes. Again, tax codes being written in pencil, not in pen. But we see a shift, like fundamentally with like pre-tax and Roth from a legislative side, because there's also with those tax law changes of forcing plans to have Roth sleeves inside of them.
Yep.
There's also restrictions of like if I make so much money and I'm doing catch-up contributions, now that money has to go into Roth if I'm of a certain age.
Yeah.
So you're seeing this kind of shift where the government for almost 60 years allowed you to defer taxes.
Yep.
Now, if you're a high income earner, you're putting in a lot higher savings rate, you're kind of being forced to do some Roth money because tax revenue is needed.
Yep.
And that plays into the inheritance side, but I'm just been talking a lot.
Yeah.
So what do you have to add, Trevor? Back to you, Trev.
Yeah, absolutely. I mean, I think you've hit the nail on the head. We love Roth for a million reasons. It is a relatively new concept. I feel like traction is gaining. I feel like more people are kind of hearing about it and they're curious about it. They're asking us about it in client meetings. But a lot of people still don't know about it. And really, I coin it as kind of the super powerful way to bucket your taxes, your tax implications when it comes to investing. And really, the main thing is it's more known. It's less uncertain when it comes to the future, right?
So if you want certainty,
if you want
Roth.
certainty, if you want kind of a sure thing moving forward, and there's never a sure thing, right? So, not saying that
there's one sure thing.
there couldn't be
salvation.
Yeah, absolutely, absolutely. Well, death and taxes are a couple other ones as well, but there really aren't a lot of sure things in finances. Roth is one of the big things that it kind of is. It's kind of that sure thing. I know what I'm going to face today, and I know exactly what I'm going to face down the road when I actually need to access this money. I know both sides of that equation, where pre-tax, you know what you have today, you know what you're getting today, you don't know what you're getting in the future. And I think, just personally, my mindset is always like, I'd rather know kind of the giant I have to face today and be able to conquer that giant today and know that I'm going to have peace after than kind of the alternative of I've got peace now and I could have a giant down the road. I might not have a giant down the road. I feel less secure thinking that way, and I think a lot of our clients do as well. So we always like to encourage, if you want a sure thing, if you want certainty moving forward when it comes to how much you're going to actually be liable for taxes with this money that you're investing, Roth is the option. That's the way to go in most cases.
Yeah. So ironically, if you want, like, it's kind of like the more conservative leaning, right?
Yeah.
Like, I'm not talking politically, but just like conservative in terms of like, I'm getting a sure thing. Like I'm hedging my bets by saying, well, yeah, I'm at this tax rate today. Like, I have the margin. I'm going to put it away. I'd rather have the tax free down the road based on the current rules. I see another side of that too, which is, it's like when I talk about even doing Roth conversions with people, there's so much information out there about Roth conversions these days, and the algorithm is probably just constantly feeding it to me. But there's so much stuff there, and the biggest reason that I encourage it for a lot of folks is flexibility.
Yeah, absolutely.
Because one of the most frustrating things is having conversations with clients who are in retirement or planning for retirement, and a big expense comes up. And let's say you have $2 million in pre-tax assets. Very commonly we see like a $950 to $2.5–3 million, and it's all pre-tax, right, of retirement assets. And maybe there's not as much like cash on the sideline because we didn't really budget very well. We never really built that behavior. Yeah. We just always maintained like $5,000 to $20,000 tops of cash. So we don't have like a lot of flexibility there to like cover things. And everything else is just tied up in pre-tax. Like we saved really well. Like we got the benefit of that. Maybe there's a pension lump sum rollover included there. And then a $30,000 expense comes up. And like we already have a plan for retirement income. Maybe there's like Social Security. There might be some pension income on top, maybe some part-time work. Yeah. And that puts us, maybe there's also like a gap we're filling with some IRA distributions, which is, if it's all pre-tax, it's coming out as taxable income, right? And then this $30,000 expense comes up. And I've had this conversation many times over the past few years where it's, hey, based on everything else we're already doing, you need this $30,000. We need to take out $48,000.
Yep.
What?
To cover the
what
tax
are you
bill.
Talking about? Like, well, based on like this is how income stacks up. This is the taxation of each of these parts of income. And based on your tax rates and based on the projections, and an extra complication today is because we're taking more income out that is taxable. If you're pre-Medicare and you're like a marketplace insurance plan, you might shift out of getting all the premium tax credit subsidies. You might owe $12,000 back for health insurance premiums that you had subsidized to start with. It's like maybe it's $30,000 taken out. Your tax, like effective tax rate on that overall, just federal, not even thinking about state, is maybe 20%.
Yeah.
So that's 30 goes up to, well, like 36, 37-ish, right?
Yeah.
And then I've got this $12,000 premium tax credit subsidy to recapture. And then I got state taxes on top of that. Like this becomes a big expense.
Yeah, it does.
And we have this conversation multiple times a year where it's, hey, like we need to be aware and be diligent with this. And this is the part where, like, I see clients doing their taxes with a CPA or an enrolled agent, whatever, and they're like, well, hey, like I want to put money in this traditional IRA to get this tax deduction. It's going to save me $1,800 on taxes this year. I'm like, that's great, and I get that. And like your CPA wants to look really good right now to like help you save money on taxes. Let me tell you the hundreds of stories of how this is going to screw you on the back end.
Yep.
Like,
absolutely.
Like, and the trajectory you're on, because I know your situation, because we've worked together for years, the trajectory you're on is to have all this extra money in pre-tax. This is your current standard of living. Here's how we're going to build your income down the road in retirement. And this is why it's like that $1,800 savings today is going to cost you $25,000 in the future.
Yep.
And people don't think about that because it's like the short term, like I want that little dopamine hit today.
Yeah.
And I'm saying all this, I don't mean to like sound condescending or like judgmental.
No,
It's
these are
just
real
the
things.
facts.
These are real things.
Like this is the facts, right? So that's where like Roth, like the case for Roth really comes into play for even these little decisions over time.
I think just adding on to what you were just talking about too, Patrick, is, we've got clients that might have $1 million in pre-tax assets. Well, when you think about the actual taxes owed on that, it's more like 2/3 of $1 million or $750,000, you know? And so you might see this number in your, in your investment accounts and you go, oh, I feel good about that. I've got $1 million. I feel great. Feel like $1 million bucks. And then when you actually go to live off of these assets, it's not $1 million bucks. It's actually 2/3 is probably too low.
It's called
probably too low. But
700,000.
Yeah. But 700,000, 750,000, that is realistic after you pay taxes. So really, you don't have $1 million. You have $750,000.
Yeah.
And I think that surprises a lot of people who they get over the perceived finish line into retirement, and then they are shocked that they face this reality of, oh, well, actually, because I got the tax benefit on the front, I now have to pay taxes on the back end.
Yeah. There's a great example of someone who did this really, really well. And I can't remember the guy's name, but he was, you might know as I start talking about, I think he was one of the founders of PayPal with Elon Musk, because wasn't Elon, like that's where he got a lot of his money to start with, PayPal, like selling that.
It wasn't Brin. It wasn't Sergey Brin.
Yeah, we'll look it up. It's a really interesting story, but like the guy basically took his initial like founder's shares of the company before it sold and like put them in a Roth IRA.
Yeah.
And now 25, 30 years later, like post sale and all that stuff, like these shares are worth several $1 billion.
Yeah. Roth
right.
money.
So you talk about like a small decision leading into a major impact, like that opens the doors for a tremendous amount of generational planning, generational wealth, or even just kind of like if you want, like a gotcha on the U.S. government.
Yeah,
right?
yeah, exactly.
And there's actually been, I think there's been some pushback and some lawsuits about that to try to recapture some of the taxes that he would owe from that.
Of course.
But they haven't overcome it, to clarify, like they have not succeeded. To my knowledge, now I'm going to have to go back and look it up and just clarify. So if the post is out there that I'm wrong, like please send it to me, let me know. But yeah, so there's all of that. And then I think you take that into the next level of, so that's like, I'm actively saving, I'm investing, I'm thinking about my future. Like, should I do pre-tax or Roth? Like, here's how these buckets work. I said 100 reasons, you said 1 million reasons of why we love Roth. I'm going to say like the next 10 million reasons I love Roth is how this money passes down when you die.
Absolutely.
Again, the tax code has changed 6 or 7 times in the past 5 or 6 years, kind of thing. Like literally 2019, 2022, I believe was a change. We had some in 2024, 2025, and like other little changes here and there. The big sweeping stuff, though, really shifted in 2019, starting with January 1st, 2020 being effective with the Secure Act, and then a couple years later, Secure 2.0, where when I pass down these qualified buckets like Pretax and Roth, those accounts, those dollars maintain that same tax status when they go to your beneficiaries, but now there's time frames on which they have to liquidate those assets. And the level of inheritance planning we have to do for people is just shocking. And like most families, again, like the average American family is never going to have to deal with outright inheritance tax on the federal level because you have to have $15 million per person passing down to like deal with that. But I'm kind of calling this like the new inheritance tax, right? It's just straight up federal taxes and state taxes, but it's basically the new inheritance tax because let's say I'm a single child, my parents pass away, I'm in my 50s, they leave me $2 million of like pre-tax retirement assets. I'm in my 50s and it's just me, right? Like in this example, I have no siblings to share this burden with. And I just inherited $2 million of pre-tax assets. I now have a 10-year window following the year of their death to liquidate this pre-tax money on top of all my other income sources and pay taxes.
And the money is most likely invested in growing still.
Yes.
So that $2 million is going to grow to 2.5,
right,
or 3 in a 10-year period.
And this is like the pre-tax, right? So like I have this 10-year window. I've got to take this money out. I also have to satisfy potentially like required minimum distributions or per year over this 10-year period. But I've got to pay tax on all that. It's like maybe I'm in my 50s. I'm making $300,000 a year. And just let's pretend it's not growing. It's $2 million. I need to take out another $200,000 a year. Well, I just jumped to the highest tax rates out there. Over the next 10 years from 55 to 65, if that's my age, to pay this money. Well, that has big ramifications. If I'm not ready to retire and I still want to work, I'm going to lose out of that $200,000 a year, roughly 40 to 50 grand, or excuse me,
50%.
50%.
Yeah.
So like 80 to 95, $100,000 out of that $200,000, I've got to deal with tax-wise. There's very limited measures of what I can do to mitigate that unless I'm charitably inclined. Like charitable giving, that's going to be your number one strategy to help out with these kind of situations. Or I could choose to like stop working or like minimize my workload and like use that as part of my income source. But what impact does that have on you down the road? Well, if I stop working as early, that money doesn't count towards my Social Security benefit.
So you're going to have a smaller benefit.
My Social Security is going to get lower, right? So like everything has a trade-off here.
That's true.
So it's not just, well, I want to save a little bit on my taxes today. It's what is the impact down the road? So that's the pre-tax. The Roth, same rule, 10-year window, 100% tax-free. So like I could pass down $2 million tax-free. Or let's say my family did have $2 million and maybe I'm in my 50s and I've only ever made like the most was $70,000 a year for my family. And it's just been a humble, like modest living over time. And they passed down $100,000. And this is a life-changing money, like life-changing money. I still want that to pass down tax-free if I can versus now it's $100,000 of additional taxable income for my family. Like for the $70,000 income family receiving this money. Like I want it to be a benefit, like a good thing, not a burden.
Yeah, absolutely. And then that's really one of the biggest questions that we ask people with large pre-tax accounts is, hey, what are your plans after you're no longer in possession of this? Who do you want to pass it down to? How do you want to pass it down? Because that impacts dramatically the strategies that we put in place. You know, if you want to pass down a sizable chunk of money to your kids or to other people, after you're gone, are you giving them a big tax bill essentially associated with that, or are you doing everything you can? And that's something we help with all the time. Are you doing everything you can to kind of mitigate the taxes that they're going to be burdened with and try to pass down as many non-taxable assets as you can? So
there's so much more we can talk about, even just like with like IRMA surcharges on Medicare, with RMD planning, with even like long-term care planning and health coverage when you get older. There's the charitable giving strategies, mitigation. There's trade-offs of income versus investments. like all these things that we deal with all the time.
Yeah.
And but most people just think about like, well, am I going to make 10% or 9%?
Yeah.
Well, who cares if you give it all to the government anyway?
Yeah, exactly.
like let's focus on what matters. So
Exactly.
we could spend another hour talking about that, and we've already spent a lot of time. So let's talk about like the third bucket, which is really the baseline bucket that all the qualified stuff is built upon.
Yep, absolutely. And really, this is the non-qualified tax bucket when it comes to investing. Meaning we're not really getting any tax benefits or tax credits on either side of the investments. So the third and final bucket that we're going to talk about today is really just after-tax or post-tax or taxable accounts. You can use those interchangeably. Plain Jane. I put my own money after tax into an account. It grows. And then I actually, as it grows, I pay what are long-term or short-term capital gains taxes on the growth inside of that account. So the money I put in, that doesn't ever get taxed because it's already been taxed once. That's why it's after tax or post-tax. It goes in. So that's my basis inside of the account. And then any growth from the investments that I have on top of that, that is the portion that actually gets taxed down the road at different rates depending on how long that money has been invested.
Yeah. And I want to reemphasize, like, this is the most basic form of investment taxation or like income taxation for investments. This is how, like, when you sell an investment property works. This is how if you just sold individual stocks or individual funds. This is how you get taxed on selling bonds. If you sell a business, like any kind of capital asset that you sell, this is where capital gains tax comes into play, the long or the short term. Long being like I've held it for more than 12 months, short within 12 months. This is also where like capital losses come into play, right? It's like you can't actually like capitalize on losses inside of qualified accounts because it's all tax sheltered anyway, right? So like it doesn't really matter. Yeah, you can do it for like reallocation purposes, things like that. But like in terms of tax planning, losses don't matter there. They do matter in non-qualified situations. But this is the most basic, right? Like it's after tax, no deduction going in. I'll pay taxes for whatever the growth is down the road. But this is kind of like the superpower account as well. Like I know we talked about Roth and like fanboyed for a second. This is the most basic investment. This is the one because there's no tax advantage qualifications. There's also no tax restrictions.
Less rules, less regulations.
I don't want to say it's the Wild West in like a negative sense, but it's like your free game, right? Like, and this is how a lot of very wealthy people kind of skirt a lot of tax rules. Like they leverage Roth and they leverage brokerage accounts. They don't do as much pre-tax, right? Like because like typically the more wealthy people, they have businesses. Which is also a capital asset. It's going to be taxed the same way. And you can use tax mechanisms in your business just like you do in the brokerage account or with real estate to like overall, like lower your overall tax bill over time.
Absolutely.
But yeah, like it's no deductions. You're just going to pay long-term capital gains, short-term capital gains, which long-term capital gains for most people is a lot more advantageous than your regular income rates, which your regular income rates come into play with pre-tax assets coming out.
And short-term assets in this bucket as well. But yeah, I mean, it really, I believe the top bound for the 15% long-term capital bracket right now is $500,000.
I think it's up to 600 this year.
600,000.
Like 600 and change,
So basically, in any given year, you could liquidate, up to $600,000 in gains of a post-tax account and pay 15% on that balance. Which in federal tax.
Yeah, in federal. There's that additional like above $250, I believe, is the net investment income tax, which is like a Medicare surcharge, but still like 3.8% on top of 15. You're talking 18.8 versus 39.6 or 35%.
Yeah, exactly.
Yeah, it's a much better situation.
And a lot of people, you'll hear financial, advisors and people out there talking about these as being bridge accounts. Patrick, you want to touch on that? Like why they're called bridge accounts, what that actually means for people, and how these kind of accounts play an important role in planning long term when it comes to retirement, comes to potentially early retirement. A lot of people are trying to retire early today. How do these bridge accounts play a role in that process? How do we advise people on how to use them to their advantage?
Yeah, so the bridge account is just like the reason we call it a bridge account. It's not like a separate type of account. It's just a taxable brokerage account.
Yep.
The reason we call it a bridge is like the function of how we're going to use it. So if I want the freedom to stop working full time, to make work optional for me before I reach the traditional phase of retirement, which is for most people 62 to 67, 68 is like when most people retire these days. If I wanted to have the freedom to not have to work as much, not have to generate as much money with my work or generate any money with work, like say in my mid 50s. This allows me to bridge that gap before I can access my retirement accounts without penalty.
Okay.
So, like, if I wanted to retire at 53, or even like in my mid 50s, I just want to take a couple years as a sabbatical. Right? I have a client that wants to do that. He wants to take a sabbatical, and we need to have money set aside for that purpose. Well, having a brokerage account that is funded that I could just use to pay myself and generate income out of, without having to access my retirement accounts with the penalty, that's where this comes into play. The cool thing about that is, like, if I started this early and I have a lot of money in there, a lot being relative to your situation, right? But if I have a lot of money in there I can use for this purpose, well, maybe I'm only going to be taking money out at a rate where, like, my capital gains income is so low that I don't even hit the 15% bracket. Like, going into 2026, the bracket shifted where if I have no other income sources and all I have is long-term capital gains, it's like $100,000, like right at $98,000 and change, right? Of long-term capital gain income I can generate and pay $0 in taxes. That's a superpower.
Yeah, it is.
Right? Like, I have the freedom to optimize my financial situation where I could effectively pay no money in income taxes. And that's where, like, these accounts are so important. And we always, like, we really push people, like, make sure we're saving 15% of our income, you know, for retirement using dedicated qualified retirement accounts, like your 401k, IRAs, ideally Roth, if we have that option or we can make it work. You know, pay off, like, have all your debt paid off, have your emergency fund, be doing the 15%. Let's talk about, like, college planning or funding for other goals down the road, pay off our house, and then let's super fund this brokerage account, because that's going to give you freedom. And that stuff will get a stepped up basis when you pass away. It's where your family or your beneficiaries can receive all of that tax free.
And on top of that, we usually advise clients, if you've got, you know, a good chunk of money in taxable accounts going into retirement, if you can draw from those before your actual qualified accounts, especially Roth accounts, that actually just allows that Roth money to continue to grow. And they might not ever need that Roth money, and they're able to just pass down this massive chunk of change completely tax-free to their, you know, to their kids or their, you know, spouse or whoever it is. And they also get to pass down the brokerage assets if they've still got them with the stepped up basis. So it's really, really advantageous.
And one thing I love to do is, like, if we have a large pre-tax balance and we have a good sized brokerage, and let's say we don't need all those resources, which is, it's a common thing, is like, if you have a lot of assets, typically you've done well enough, like your lifestyle is such that you're not going to have to burn down your assets. We could use the brokerage assets to pay the tax bills, to do conversions of the pre-tax into Roth. And that, again, goes into, like, Medicare planning, health insurance planning, long-term care needs, charitable giving, like all those strategies. But we can do that to make your portfolio more tax efficient, to, you know, create a bigger legacy or give yourself more freedom and flexibility down the road.
Absolutely. And I think that we both kind of see this the same way.
We need a dissenting opinion here. We need someone to be like the heckler on the side. You know?
The Roth in tandem with the taxable money, it's like the 1-2 punch. It's just, you got such a powerful attack. You got such a powerful, you know, pile of assets for you, for your family, for your descendants. It's just such a really, really good kind of strategy and combo to have both of these in play in your financial situation. So obviously, getting the 15% into the qualified accounts, and then anything above and beyond that we can kind of use for long-term investing, gosh, you can't beat Taxable. It's just, it's a really, really powerful tool. Yeah. And a lot of people don't know about it. I feel like we always hear about, oh, well, my 401k is either pre-tax or it's Roth, or we don't really hear people talk a lot, at least just in layman's terms, about taxable brokerage accounts. Yeah. And they're the simplest and oldest thing out there when it comes to these different tax buckets.
It is the fundamental way to invest and how you get taxed on it. So, and there's so much more we could talk about around like planning strategies. I think we should get into that over time, but I feel like we've probably hit this one really hard.
Absolutely.
So definitely reach out to us with questions. If you guys have any, or if you want to hear more deep dives on this, we'd be more than happy to record some more content about it. But thank you guys for tuning in. Give us a like and a share, and we'll catch you next time. Discussions in this show are for entertainment and educational purposes only and should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Securities offered through registered representatives of Cambridge Investment Research, Inc., a broker-dealer and member of FINRA and SIPC. Advisory services through Cambridge Investment Research Advisors, Inc., a registered investment advisor. Cambridge and neither SmartPro Financial nor Bridgeway Wealth are affiliated.